So imagine this. You're driving to work, right?
I
And suddenly your car just completely breaks down on the highway. Like engine smoking, total disaster.
Oh, man. Yeah, that's a bad morning.
Right. But instead of being upset, you just start cheering. You pop a bottle of champagne on the side of the road because, hey, it means you don't have to commute to work today.
I mean, that is definitely one way to look at it.
It's insane, right?
Mm.
But that is exactly what Wall Street did this week. For the week ending August 7th, 2026, the U.S. economy unexpectedly lost jobs. And yet, the stock market, through this absolute euphoric buying panic.
Yeah, pushed right up to all-time highs.
Exactly. Welcome to the Deep Dive. Our mission today is to tear into this week's market research report, figure out why in the world bad news is suddenly good news, and, get you prepped for a really critical data gauntlet next week. So, okay, let's unpack this.
Let's do it.
The July jobs report. We lost 23,000 actual jobs.
Which is a shocker.
A huge shocker. I mean, what was the forecast?
The consensus was that we would add 80,000 jobs. So losing 23,000 it's a massive, massive miss.
And it wasn't just July, right?
No. They revised May and June downward too, by a combined 103,000 jobs. So the labor market isn't just cooling off, it is actively shrinking.
But the markets just ignored that entirely. I mean, S&P 500 went up 3.6%.
Yep, hit a brand new all-time high of 7,757.64.
Unbelievable. And the Nasdaq surged 5.2% to close at 26,690. Even the Dow crossed the 54,000 milestone.
Up 3%.
Yeah, and the Russell 2000, which is usually super sensitive to the domestic economy, that jumped 3.5%. So why on earth is Wall Street celebrating a shrinking labor market?
Well, it all comes down to what we call the Fed Hike Boogeyman.
Okay, explain that.
So for the last couple of years, the biggest fear on Wall Street has been the Federal Reserve raising interest rates, right? Higher rates make borrowing more expensive, which hurts corporate profits and pushes stock prices down.
Right, the cost of capital goes up.
Exactly. So when the market sees weak labor data, they view it as absolute proof that the Fed's rate hike cycle is finally over.
Ah, I see.
They look at it and say, well, the economy is slowing down, so the Fed can't possibly raise rates in September, and that lower expectation for interest rates just sent stocks flying.
So bad news for the economy is good news for stocks because it means cheaper money.
Precisely. But, and this is a big but, there's a catch.
Always is.
If you look under the hood, the market is celebrating, but the VIX, which is the volatility index.
The fear gauge.
Right, the fear gauge, it's still hovering near 20.
Wait, really? With the S&P at all-time highs?
Yep. And a VIX at 20 tells us that institutional desks are still buying a lot of downside protection. They're chasing this rally because they have to, but they don't completely trust it. There is a lot of caution just beneath the surface.
Wow. Okay. That is super interesting because if the stock market's entire rally is based on this assumption that central banks are just going to back off, we really need to look at what those central banks actually did this week.
Right, and the reality is a bit different than the narrative.
Exactly, because the Federal Reserve, the Bank of England, and the Bank of Japan, they all just maintained their current interest rates. Nobody cut anything.
No cuts at all. They're all in a very strict wait-and-see mode.
But here's where it gets really interesting. At the Fed, it wasn't a unanimous decision to hold, was it?
No, it wasn't. And that's a huge detail. We saw a 9-3 vote on the committee.
Right. 3 regional presidents dissented. They wanted to maintain hawkish pressure.
Which means a quarter of the Fed is still deeply worried about inflation. They aren't ready to declare victory yet.
So isn't the market getting totally ahead of itself here? If 25% of the Fed still thinks inflation is a threat, how can Wall Street be so confident that rate hikes are dead?
You're spot on. The market is definitely getting ahead of itself, but they got a little bit of a geopolitical gift this week that made them feel safer.
You're talking about the Middle East.
Yeah. There was a sudden sort of truce in the Strait of Hormuz, and because of that easing of tensions, Brent crude oil prices actually fell 0.3%.
Oh, wow. Okay, so that acts as a massive tailwind.
Exactly. It reduces the fear of an energy shock, which lowers supply chain inflation fears. So Wall Street looks at the shrinking job market, which cools wage inflation, and they look at falling oil prices, which cools energy inflation, and they think, perfect, inflation is dead.
But that 9-3 vote proves it's not completely dead yet.
Right. The internal friction at the Fed is still very real.
Okay, so exactly. Which leads us perfectly into this week's earnings reports. And man, The numbers were just staggering.
Honestly, some of the best we've seen in years.
Yeah, I mean, 86% of S&P 500 companies have beaten their EPS estimates.
Which is the highest rate since 2021.
And it wasn't just small beats. Palantir surged, what, roughly 30% on a massive revenue beat?
Yeah, a huge top and bottom line beat.
And then Apple wrapped up the mega cap season. They had steady iPhone demand, but also this really strong growth in their AI services.
Right, the AI integration is really starting to show up in the revenue streams.
So I have a question about this whole AI narrative, because for years we've heard about the picks and shovels of AI, right? Like the companies building the data centers and the chips.
The infrastructure phase.
Are we finally seeing the actual gold? Like, is the Palantir surge proof of that, or is this just more hype?
No, it is absolute proof. This is a very clear signal that AI demand is moving beyond just, government defense contracts and into the private sector.
Okay, how so?
Well, Palantir's 30% jump shows us what we call the industrialization phase. It's the software and implementation phase of the AI bull market. Companies are actually buying the software to make their businesses run better, not just experimenting with it anymore.
So they're using it to cut costs and boost margins.
Exactly. And that explains why tech growth, and specifically the Nasdaq's massive 5.2% surge this week, is still the dominant theme. Real companies are spending real money on AI to get more efficient.
Okay, that makes sense. So we have record highs, we have this softening labor market that Wall Street loves, and we have booming AI earnings.
A pretty potent mix.
It is. But all of this optimism is about to get violently tested. Let's shift to what our listeners need to watch out for next week, because the catalysts are huge.
Yeah, the calendar for August 10th through the 14th is stacked.
Okay, so Monday the 10th, that looks like mostly market consolidation, right?
Yeah, probably just desks digesting the wild moves from Friday.
But Tuesday the 11th, things pick up. We get Australia's RBA rate decision and U.S. existing home sales.
Both important, for sure.
But Wednesday, August 12th, that is the critical one. We get the U.S. CPI report, the Consumer Price Index.
That is the big kahuna.
So what does this all mean? Like, if CPI comes in hot on Wednesday, doesn't that completely destroy the whole bad news is good news narrative we just talked about?
Oh, absolutely. It is the ultimate make or break moment for this market.
Break it down for me.
Okay, so if inflation cools down, and that lines up with the weak jobs data we just got, then Wall Street's dream of a soft landing is pretty much set in stone.
The Fed can cut rates, everybody's happy.
Exactly. But if inflation is sticky, if that CPI number comes in hot on Wednesday while the job market is simultaneously wilting...
Oh, man.
Yeah. That introduces stagflation.
Stagflation, the exact word Wall Street fears most.
Right. Because it means prices are going up, but growth is going down. And if that happens, the Fed is trapped. They can't cut rates to save the jobs because they have to fight the inflation.
So that CPI print on Wednesday is literally everything.
It is, and it doesn't start there. Thursday the 13th, we have the U.S. Producer Price Index, the PPI, and UK GDP.
And then Friday the 14th, U.S. retail sales and the U of M consumer sentiment data.
Plus Cisco earnings, which is a huge bellwether for AI infrastructure spending.
Man, what a week.
Yeah.
What should people be looking for in those Friday retail numbers?
You want to see if this muggy, shrinking jobs market is finally hurting everyday American consumer spending power. If retail sales tank, it means the consumer is tapped out, and this soft landing narrative might just evaporate.
So the data gauntlet is real.
It's very real. And honestly, it leaves me with a pretty provocative question that I think everyone listening should ponder this weekend.
Ooh, let's hear it.
So we talked about how an astonishing 86% of S&P 500 companies beat their earnings estimates right now, highest since 2021.
Right, which sounds incredible.
It does. But the question is, are these corporations genuinely performing at some historic, unprecedented level of excellence? Or have financial analysts just lowered the bar so much over the past few months out of fear of the Fed that literally anyone could step over it?
Oh, wow. That's a great point.
Right, because what happens to this market when the bar finally gets raised again? If you're just rewarding companies for surviving a low bar, the multiple expansion we saw this week might be incredibly fragile.
Yeah, when reality hits and they actually have to show real organic growth.
Exactly. It could get ugly.
Man, that is definitely something to chew on. Well, thank you all for joining us on this deep dive. You are now fully armed and hopefully well-informed to navigate the incredibly volatile week ahead.
Keep an eye on that Wednesday CPI print.
Seriously, watch how the market reacts. Have a great weekend, everyone.